So, Rick, thanks for joining us for the Adansonia quarterly update. How's things been traveling in international equities?
Hi, Rob. Thank you very much. Always a pleasure to be here. Things have been traveling well. We had a strong end of the financial year. The portfolio was up 8.3%, outperforming the market by 2.5% for the financial year. We delivered 17.4%, a little bit behind the index, unfortunately, which is at 18. And since inception, we're running at 16.5% per annum for a bit over 6.5 years now, outperforming the market by 1.5. But look, global market continues to be relatively resilient. I mean, essentially all the indices are largely bouncing off record highs. And obviously, it's all about tariffs and AI at the moment. That's dominating the market. But we've got a relatively optimistic view on the outlook for the market, in the sense that we think that the worst is behind us for financial markets. We won't go back to April. We won't see the same reaction in the market with respect to that we saw in Liberation Day. And look, 1 August is obviously a big day. I'm not saying there's not going to be bumps and obviously the odd shock, but generally, the market had a very, very strong reporting season last quarter. We're just starting the reporting season now for this quarter. But look, the stocks didn't really move as they should have, and that was obviously with the overhang of the tariffs, largely. So you had there's a bit of a pent-up tailwind on the back of that. And look, what we're seeing is that the quality of the index, as we define it, which is obviously dominated by US companies, is improving. So the corporate tax rate in America has fallen from, I think, 35 to 21%. That's releasing more cash flow. You've got more service companies that are now dominating the index. So obviously they generate higher margins and higher return on capital than capital heavy companies. And what we're seeing is that essentially, and we saw it in the last quarter, that earnings are being driven by productivity gains. So it's largely started, I guess, from COVID, but essentially there's been a tremendous investment in automation and digitization, and that's starting to yield fruit. And essentially, it's driving earnings, and obviously key philosophy in our investment process is that corporate earnings drive share prices, and some saying that's doing well. On the back, on top of all of this, the US consumer is holding up pretty well, and we're still seeing that there's a large degree of money still on the sidelines. So, we believe that the market is generally underinvested. So that should also help going forward. So we're not saying that the market is screamingly cheap. We think it's fairly valued, but we don't think it's overvalued. And, the market just continues to sort of bounce or set successively new highs, and it doesn't necessarily mean it's going to top out. In saying all of that, it's very much driven, day by day by news flows out of the White House, and we just have to basically see what's happening. But all in all, we released those tariff papers and sort of talked about it before. We don't really see that that the imposition of the tariffs is the be all and end all for the US consumer and for inflation. And we can talk about that more. But look, it'll be absorbed by the consumer, by the exporter. We believe that the shock to pricing will be, 1% or less, with a blended tariff around 10 to 13%. And essentially, it's just going to create large revenues, in the hundreds of billions of dollars for US Treasury. In actual fact, in June, the US Treasury actually reported a surplus. And it's the first time that essentially tariff revenue has exceeded $100 billion in the financial year ending June. So it's moving forward, obviously not without bumps and challenges.
Yeah, well, it'll be interesting to see what pans out with the tariffs, but I think it's fair to say the market's sort of got its head around it. And you mentioned the index domination. So previously we've had the tech space being a large component of that. We had the Magnificent Seven. How's that all panning out at the moment? And what's I mean, I guess, when you sort of see markets going up, you want to see a healthy broad rise in the index. You don't want to see it dominated in a few companies. So what's the latest on, that sort of space?
Yeah, so look, obviously, when we basically had I guess the bounce of the lows from Liberation Day, essentially a lot of money left the US market, and essentially you saw a very, very strong uplift in Europe. I would say that, look, obviously the big AI dominated companies are still largely driving the market, but there has been a broadening of the index in terms of what's moving it forward. It's not being propelled by several large companies, and that's obviously, just going backwards a little bit. That's why we underperformed last financial year, because we weren't invested in companies like Tesla and Nvidia, which dominated the market. They've had a little bit of a reality check, and sort of come back to levels that are more fundamentally based, but still we don't see them as screamingly cheap. So yeah, look, Rob, I think generally at the moment, AI is gaining traction again, and those companies are moving things forward. Obviously, with DeepSeek, that was essentially announced by the Chinese, I think end of last year from memory. That basically put a huge question mark over the dominance of the US with respect to the AI space, and also the investment in AI that a lot of the corporates were making, if they get a proper return on it, given that apparently DeepSeek, generated the same, had largely the same functionality for a fraction of the price. So saying you sort of had, like a wave of capital out and a wave of capital come back in, but it's broader than what it was before.
Yeah. So Adansonia is a very much a conviction manager. So we've got a number of concentrated exposures in areas that you like. What's the I guess what's a couple of your current favorite stocks at the moment, and why are they sort of things that you expect to do well over the short to medium term?
Oh, wow. Okay. Yes, look, we've got 13 shares in the portfolio, Rob, running about 7% cash. Look, I guess at the moment, we're very much thematically driven, and our key exposure to AI is through a company called Taiwan Semiconductor Manufacturing Company Limited. Obviously, it's through the ADR, which is US listed. And look, they likely generate 90% of the world's chips, and are basically invested. They're also producing on US soil, and have basically committed a further $50 or $60 billion to basically grow production capacity on US soil. So largely they produce the bulk of the chips that go into largely anything electronic, from Apple iPhones through to they make Nvidia chips, etc., like that. So they, it's a company that's broad based and largely being driven by the AI boom, and also, as AI, starts to, I guess, benefit from the next leg, which is physical AI through robotics. So they'll also essentially be very much leveraged to that. We like Uber. That's the sharing economy. Again, it's interesting to see how the market is essentially supporting Tesla on the back of robotaxis, essentially, and believing that it will kill the outlook for Uber. We don't believe that's the same. Uber has essentially the dominance of the market with respect to booking, and the app. It's a truly global player, and we believe that essentially robotaxis, very much driven by Waymo, where they have the relationship with Uber, will move the stock forward. What else do we have? Look, we were invested in JP Morgan, which is the world's largest bank, and again, which is also has many prongs, more so than what the domestic banks do, with respect to investment management and corporate banking, as opposed to domestic banks that are just savings and finances, trading on a multiple that is a fraction of the domestic banks, and also a far smaller price to book. Look, they're probably the largest players. We don't own Meta, we don't own Apple, we don't own Tesla in the Magnificent Seven, all on valuation grounds. So as I mentioned, this is one of the issues that we see with passive investing, that you end up, owning companies in your portfolio as a function of their size versus their fundamental value, and so we sort of cherry pick the best that we can find.
So you do own Google, yeah?
Yes, we do. Alphabet, yeah.
Yep, Alphabet. So what's the the premise behind that stock. And interestingly, the price earnings of Google's actually quite reasonable.
Very much so. So look, so Alphabet's trading on around 18 times. For a company that has that growth outlook, it's quite cheap. Look, it's been hit to a degree by so number one, it's the leader in search. So essentially, we believe that it has that market largely cornered, and the advertising revenues from that are continuing to be very strong. So look, it's currently based. It's got such a market presence that it's under constant threat by regulators of antitrust issues and being broken up. Whether or not that happens is a different story. We don't believe that the Trump administration will let that happen. But even on our work, even if it does get broken up, the sum of the parts is greater than the whole with respect to Alphabet. So look, we're very happy with that stock, and I forgot about that one. That's also one of our largest holdings. As I said, yes, you're right. Trading at a very reasonable multiple versus some of the other shares that are out there. I mean, case in point, going back to Tesla, is trading on about 100 to 160 times earnings. Just don't understand the blind support for that stock, versus a share like this, which is trading around 18.
Yeah, yeah. And what sort of profit growth has Google had for over a long period of time? I mean, it's been substantial, yeah?
Look, off the top of my head, I can't remember, but it'll be in the mid to high teens.
Yeah.
So this is the thing, with respect to the way which we invest, Rob, we look for companies that have long runways of organic growth, where essentially they can compound out that profit growth over a period of time. And US shares don't pay much of a dividend. They basically reinvest their earnings to grow the companies out, to grow earnings out over time. So again, Alphabet is a company that essentially has that runway, that long runway of organic growth, and has been doing so. But yeah, very much growing EPS very strongly, and also revenue growth. We look for companies that can grow revenue growth, at a rate which is greater than that of nominal GDP, and also it's basically satisfy that on the top line. So, no, it's a great company, and this is the thing, is that we believe also as the US starts to cut rates. So obviously, what we're seeing is that the ECB has largely led the rate cutting cycle. The US Fed has sort of sat on its hands. Inflation's been a little bit stickier. It hasn't really known. I guess it has to sort of see some clarity with respect to some resolution or negotiations concluded around some of the key trading partners with respect to tariffs, and also the big beautiful bill being passed. But largely, inflation numbers have been coming in a bit below expectation. The last print was a little bit higher, but generally we sort of see now that the US, the Fed is in a position where it can start to cut rates, and even inflation being sort of kept in check. As we sort of said, that the impact from tariffs, we believe, isn't going to drive inflation to dizzying heights within the US. And the Federal Reserve will see through this as a one-off. So inflation largely being kept in check. Lower interest rates will basically help the US deficit, the US budget deficit. As I mentioned, the tariff revenue which is coming in will also basically look to reduce the budget deficit rate from around 7% to around 4%. And bring debt to GDP to more normal levels, and the combination of debt stabilization, lower rates, a redistribution of capital, and job creation, we think will continue to be basically very supportive for the US economy and the US dollar. So you've had the US dollar pretty much fall out of bed, as I mentioned before, for this capital outflow, and it's been largely, I guess, held to ransom by bond vigilantes. And not that I want to get into that people far smarter than me to talk about that, but we still see that the greenback is the reserve currency, and it'll come back. So essentially, with respect to our portfolio, which is largely US based, not only will we sort of see an underpinning or a tailwind to corporate earnings from a better economy, but also I guess from a translation into Australian dollars, the US dollar, we believe, will recover, and be a second fillip to returns, because it's been a bit of a drag on on the portfolio and the index as well. Simply when you translate, US dollar based share prices to Australian dollars, given the US dollar has sort of come off a
Mm.
bit.
You mentioned passive investing and just talking about the situation there with Google trading at 18 times. Obviously, the biggest company in Australia is Commonwealth Bank, so it's around 11% of the index. Commonwealth Bank is trading on around about 21 times earnings at the moment, and its profit growth is nowhere near that of Google.
No, 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 no. Or JP Morgan.
It's eons away.
Yeah, no, exactly. And look, this is as I sort of mentioned before, as I sort of said that we saw the Australian market. I think yes, the Australian market has also been bouncing off of record highs. I mean, not that we're focusing horribly or terribly on the Australian market, but I can't fundamentally or at a high level see the attraction. In the sense that you're very much, Australia is very much tied to the benefit, tied to the outlook for China. China is basically, facing some real issues. It's currently sort of, in a deflationary environment, not being helped by the Trump tariffs. This is sort of why there's, apparently an agreement around tariffs in principle with China, apparently. But look, you would argue that iron ore exports are close to peaking or have peaked. And as you say, you've got a government which I think respectfully can be described as fiscally inept. Essentially, Chalmers, I think, he's fantastic at buying votes, but not much else. So hard to sort of see what the outlook is. So I mean, really, the Australian market, I think, benefited from the anti-US trade and flows from the US market into the Australian market, because essentially, when it came to looking at tariffs, I mean, Australia, has a trade surplus with the US, and essentially, currently a 10% tariff. Although who knows where that will basically end up, because we refuse to negotiate with the US government. And at the moment, the UK has locked in a 10% tariff level, but those companies that haven't, are being sent letters with far higher tariffs than would have been originally expected, to bring them to the table, which we'll find out what happens there on 1 July. So you're right. So essentially, I think CommBank has been very much helped by flows, that have sort of come from the US market, and around the world, globally, obviously within Europe as well, but also into Australia. And when things normalize, as I mentioned before, our outlook for the greenback is not as negative as some. We believe that it will basically regain strength, and still be the reserve currency, at least in our lifetime. I think that will basically be a headwind for the US for the Australian market. So again, just fundamentally, as I mentioned before, we continue to see a US economy that essentially has a plan or levers or drivers to promote growth, to promote productivity, to promote investment, lower taxes, and to trade its way out of its fiscal debt. Sorry, out of its fiscal deficit. Very hard to see that within the Australian market, in the sense that essentially all the data within the Australian economy appears to point that the fact that it's the private sector is dead, and it's the public sector that's been basically spending. It's the public sector that's been basically pushing up inflation. And as public spending basically is coming off, inflation is falling, but then so is growth. And the fact is that there's very little incentive, for the private sector to invest and to grow, because it seems that the mantra of this government here is to try to tax their way out of the current situation, rather than basically grow its way out of the situation. So it's essentially the US is trying to basically make the golden goose lay more eggs, and essentially in Australia it appears that we're trying to flog the goose, to death.
Yep. No, I think that's a fair analogy, and it's Australia's been in a per capita recession slash doldrums for quite a number of years now.
I think 7 of the 8 last quarters. Yes, we've been in a GDP per capita recession. Exactly. Yeah. So
which is not good.
No. As I said, look, I mean, obviously, it's a little bit out of the brief of this conversation, but you also see it with respect to what it means, for people's lifestyles. The immigration is unchecked. And even, with the talk that the Labor government is sort of, saying they'll get immigration under control. I think May was a record level of immigration into Australia. So I don't know. I'm sort of saying is that, there's a lot of negative news out there about Trump and what Trump is doing. And I'm not saying that essentially he's executing um, in a way that sometimes makes a lot of sense. But what I'm saying is that he's got a plan.
Yeah, he is having a crack.
He's having a crack. He's trying to
yeah.
do something, and that's what he was elected for. And again, as I said, just can't see that here to the same degree.
Yeah. And I guess the other thing with Australian stocks is we've got this big pool of superannuation money, and we've got this big home bias. So I think we can't underestimate how much that sort of holds up our market as well. Because we're very parochial when it comes to investments, be it property or even the share market. So
No, very much so. And as you say, it's a very parochial market, and it basically helps to support some high multiples in a global context. And again, as you mentioned, the banks, although the banks, as you say, have been trading at ridiculously high levels, but also just some of the resource companies that we have, like the Australian energy shares, trade at far higher multiples than what the global counterparts do, simply because you've got mandates that are captive to them, and there's only 3 or 4, or maybe less now. Oil and gas stocks that you can invest in. So again, yes, very much also a function of the set up a lot of investment mandates.
Yeah. Rick, mate, thanks for joining us this quarter. Congratulations on continuing to do good work. You've been doing good work over a long period of time, so keep the good work up.
Thanks very much, Rob. A pleasure. And again, thank you very much for all the support from the network, and from you as well. We very much appreciate it, and happy to chat next quarter.
Good on you, Rick. Thanks, mate.
Rob. Cheers.